Hello, I'm John AG, and there's a moment that happens before most people realize something important has changed. When nothing feels broken yet, but something feels misaligned. It's not panic, it's not fear. It's a quiet sense that the numbers you're looking at are still correct, but the meaning behind them has shifted. That realization doesn't arrive with headlines or urgency. It arrives with discomfort. Most people believe danger in markets announces itself loudly. In reality, danger usually appears when explanations sound smooth, when forecasts feel confident, when disagreement disappears, because certainty doesn't reduce risk. It often concentrates it. And right now, one of the most unsettling features of the precious metals market isn't volatility. It's how aligned the largest institutions in the world have become. There's a deeply comforting belief many investors carry, often without realizing it, that big banks are conservative by nature, that they move slowly, that they hedge every scenario, that when they make aggressive calls, it must mean the path ahead is unusually clear. That belief feels logical. It's also misleading. Large institutions don't wait for clarity. They position for transitions. And transitions rarely feel obvious while they're happening. That's why a single number can feel heavier than it should. $6,300 per ounce. Not shouted, not hyped, issued calmly by one of the largest financial institutions on Earth. A price target that implies gold nearly doubling from current levels in a relatively short window. When a bank managing trillions puts that number into the world, it's not about excitement, it's about conditions. As I'm speaking, gold trades around $3,400 per ounce. Silver sits near 73. The gold to silver ratio hovers around 47 to 1. These numbers matter not because they predict the future, but because they define what feels normal right now. And normal is dangerous. Normal assumes continuity. It assumes the next chapter resembles the last, just slightly extended. What makes this moment different isn't one bank's projection. It's the absence of meaningful disagreement. Deutsche Bank, UBS, Societe Generale, Morgan Stanley, Goldman Sachs, Citi, different models, different risk committees, different incentives, yet the same directional conclusion. Gold higher, much higher. The debate isn't whether gold rises, it's how far. That kind of alignment doesn't emerge randomly. It forms when multiple frameworks start pointing to the same stress points. And those stress points didn't appear overnight. They accumulated quietly over the past several years, becoming impossible to ignore only after prices began responding. In 2025 alone, gold reached 53 new all-time highs. Not one breakout. Not a single speculative spike. 53 separate confirmations that prior ceilings no longer mattered. The average annual gold price rose more than 40% compared to the year before. Global demand exceeded 5,000 tons for the first time in recorded history. These weren't forecasts. They were outcomes. And outcomes force institutions to update assumptions. Here's where the false comfort trap tightens. Many people assume that after such a run, upside must be limited, that assets which have already performed are due to rest. But markets don't correct because something feels expensive. They correct when incentives change. And for institutions, the more important question isn't how much gold has risen, but whether the forces driving it higher are still active. Timing adds another layer most people gloss over. Just days before one of the most bullish institutional gold forecasts ever released, gold experienced its sharpest single-day decline since 1983, a move severe enough to trigger historical comparisons, severe enough to shake confidence, severe enough to make people question whether the cycle was ending. The intuitive response would have been caution. Instead, the response was conviction. The sell-off didn't weaken the thesis. It reinforced it, because institutions interpreted that drop not as a change in trend, but as a liquidity event, a positioning reset, noise inside a larger structural move. That distinction matters more than the price target itself. It tells you how volatility is being understood, not as danger, but as friction. And friction is expected when markets transition from one regime to another. One of the least discussed drivers behind this institutional stance sits quietly beneath the surface: the distinction between real assets and paper claims. For decades, financial assets dominated: stocks, bonds, currencies, claims on future cash flows backed by policy credibility. That framework rewarded leverage and punished patience. But inflation altered that relationship. Debt expansion exposed it. Political constraints tightened it. Suddenly, assets that depend on confidence began competing with assets that don't require it. Gold doesn't need growth assumptions. It doesn't need earnings forecasts. It doesn't need policy promises. It simply exists outside the system that manages everything else. Central banks understand this better than anyone. They don't buy gold for yield. They buy it because it doesn't depend on their own credibility. When the institutions responsible for monetary stability quietly increase exposure to an asset that sits outside their control, it tells you something about how they view future constraints. Policy uncertainty amplifies this dynamic. Even before decisions are made, leadership changes as central banks alter expectations. Markets don't wait for action, they price possibility. A new Federal Reserve chair implies different tolerances, different reactions to inflation, different priorities under stress. Gold responds not to policy itself, but to uncertainty surrounding it. At this stage, most investors focus on the obvious risk, missing upside, being too cautious, watching prices rise without participation. But the larger risk is misunderstanding why prices are moving at all. When gold is treated as a trade instead of a signal, positioning becomes fragile, because trades rely on timing. Signals require interpretation. Silver complicates that interpretation. Unlike gold, silver lives in two worlds. It's a monetary metal and an industrial input. Solar panels, electronics, medical equipment, electric vehicles. Demand doesn't wait for sentiment, it follows production. That dual identity creates leverage. When conditions align, silver outperforms. When conditions break, it underperforms violently. The current gold to silver ratio reflects that tension. At roughly 47-1, silver appears expensive relative to long-term averages. That could mean overextension, or it could mean the relationship itself is changing as industrial demand becomes structural rather than cyclical. Ratios don't give answers, they highlight pressure points. There's also a layer that didn't exist in previous cycles: tokenized gold. Digital claims on physical metal, traded like cryptocurrencies, designed for investors who value speed over custody. These products lower barriers. They also introduce dependencies, issuers, audits, regulations, platforms. Convenience always carries hidden assumptions. Physical gold removes counterparty risk but introduces logistical friction. Digital gold removes friction but reintroduces counterparty exposure. Neither is perfect. Both behave differently under stress, and stress is where these distinctions stop being theoretical. All of this creates a market environment where confidence feels abundant but fragile. When everyone agrees on direction, surprises rarely come from the expected side. They come from what no one felt necessary to question. Not because the thesis is wrong, but because its assumptions were incomplete. The deeper issue isn't whether gold reaches $6,300. It's what breaks first if confidence is tested. Currency stability, policy credibility, industrial supply chains, investor psychology. Markets don't fail loudly at the beginning. They fail quietly through small misalignments that compound. And when those misalignments finally surface, prices don't adjust politely. They gap. If there's an uncomfortable truth here, it's that institutional consensus doesn't eliminate risk. It redistributes it. It narrows exits. And the moment that determines whether this alignment represents foresight or fragility hasn't arrived yet. But it's approaching. Not because of fear, because of certainty. Confidence doesn't usually collapse when markets are loud. It collapses when markets are explained too well. When every move has a narrative, every pullback has a justification, and every risk is framed as manageable. That's when assumptions harden into beliefs. And beliefs, once embedded, don't break easily. They fracture. The recent volatility in gold is a perfect example. To most observers, the sharp decline felt like a warning, a reminder that nothing moves in a straight line, a signal that maybe the run had gone too far, too fast. But institutions didn't respond with caution, they responded with reinforcement, and that reaction tells you far more than the move itself. There's an important difference between volatility driven by fear and volatility driven by positioning. Fear drains liquidity. Positioning reshuffles it. When investors panic, they abandon assets entirely. When positioning unwinds, capital doesn't leave the system. It changes hands. The recent gold sell-off looked far more like the latter. No collapse in physical demand, no reversal in central bank behavior, just leverage adjusting to price. That distinction matters because it defines how institutions manage risk. They're not afraid of price movement, they're afraid of incentive failure. As long as the underlying forces remain intact, volatility is tolerated, even welcomed. It creates entry points, resets exposure, and tests conviction. From that perspective, sharp corrections don't contradict a bullish thesis, they validate it. This is where the comfort people place in paper assets becomes relevant again. For decades, investors learned that drawdowns were temporary, that central banks would intervene, that liquidity would expand, that policy would cushion losses. Those lessons were reinforced repeatedly until they felt permanent. But permanence is an illusion in markets, especially when constraints tighten. Inflation exposed one of those constraints. It limited how aggressively policy could respond without consequences. Debt exposed another. Political pressure exposed a third. Suddenly, the tools that once stabilized markets began introducing trade-offs. And when tools stop solving problems cleanly, confidence begins to migrate. Gold benefits from that migration not because it promises returns, but because it promises neutrality. It doesn't require growth. It doesn't rely on credibility. It doesn't need policy alignment. It simply holds value relative to systems that are under pressure. That's why central banks accumulate gold quietly, not to outperform, but to offset. This is also why institutional consensus has formed around gold rather than silver. Gold's role is singular. It's monetary. Silver's role is conflicted. It depends on both monetary demand and industrial activity. That dual dependence creates opportunity, but it also introduces fragility. When growth expectations shift, silver feels it immediately. Industrial demand isn't theoretical. Solar deployment, electrification, medical technology, these are real inputs requiring real material. But industrial demand is cyclical. It responds to economic conditions. When growth slows, consumption doesn't decline gently, it contracts. And that contraction hits silver harder than gold. That's why silver often lags during early stages of uncertainty and outperforms once momentum establishes. It's reactive before it's expressive. Investors who treat silver as leveraged gold often misinterpret this behavior. They expect immediate confirmation. Instead, they experience volatility that tests patience before rewarding it. The gold to silver ratio reflects this tension. At levels below long-term historical averages, it suggests silver has already absorbed optimism. That doesn't mean silver can't rise further. It means expectations are embedded, and embedded expectations change how markets respond to news. Positive developments produce diminishing marginal gains. Negative developments produce outsized reactions. This dynamic is often misunderstood. Investors assume rising demand automatically leads to rising prices, but markets are not linear. They are reflexive. Price influences behavior. Behavior influences supply and demand. When prices rise too quickly, they invite substitution, hedging, and speculative positioning that can overwhelm fundamentals temporarily. Another layer of complexity sits in how access to gold has evolved. Tokenized gold products promise efficiency, exposure without storage, liquidity without logistics. They appeal to a generation accustomed to instant settlement and fractional ownership. But efficiency introduces new dependencies: custodians, auditors, legal frameworks, platforms. Each dependency is stable until it isn't. Physical gold removes counterparty risk, but introduces friction. It doesn't move quickly. It doesn't trade instantly. That slowness is often framed as a disadvantage. In reality, it can be stabilizing. Assets that can't be sold instantly are less likely to be sold impulsively. That difference becomes important during stress. Digital representations of gold increase velocity. Velocity increases sensitivity. Sensitivity increases volatility. None of this negates the long-term thesis, but it changes the experience. Investors exposed through highly liquid instruments feel price moves more acutely, and acute experiences often provoke emotional decisions. This is where anchoring becomes dangerous. Institutional price targets don't just inform expectations, they shape them. 6,000, 6,300, these numbers become reference points. Pullbacks feel temporary relative to them, rallies feel justified. But if conditions change, those anchors don't adjust gracefully, they snap. History shows that precious metals, bull markets rarely end quietly. They end through exhaustion or policy shifts. But before either occurs, they pass through phases of discomfort, long consolidations, sharp reversals, periods where conviction is tested without being invalidated. Institutions survive these phases because they design positions for endurance, not precision. Second-order effects matter more than headlines during these phases. For gold, it's not just inflation data or rate decisions. It's how governments respond to fiscal strain. It's how currencies are defended. It's how reserve strategies evolve quietly in the background. Small reallocations at the sovereign level create flows that dwarf retail participation. These flows don't announce themselves. They appear gradually, then suddenly seem obvious in hindsight. Gold absorbs them without drama until the cumulative effect becomes visible in price. Silver doesn't absorb them the same way. It reacts more violently because its market is smaller and its supply less flexible. For investors, the temptation is to simplify all of this into a directional bet. Gold up, silver up more. But simplification removes context. It ignores timing risk, liquidity needs, and emotional tolerance. The right asset held incorrectly feels indistinguishable from the wrong asset entirely. Institutions understand this. That's why their positioning often looks dull until it suddenly doesn't. They don't optimize for excitement. They optimize for survivability. And survivability becomes the priority when confidence migrates rather than disappears. The pivot point in this narrative isn't a price level, it's a question. What would need to happen for this consensus to be wrong? What policy shift would restore confidence in paper assets? What growth surge would redirect capital back into risk? What structural change would reduce the appeal of assets that don't depend on trust? These invalidation points matter more than upside targets. They define risk, and right now they appear distant. But distance breeds complacency. Markets are efficient at ignoring low probability outcomes until they suddenly dominate behavior. This is where most participants struggle. They experience markets emotionally rather than structurally. They feel confident during alignment and anxious during divergence. They interpret noise as signal and signal as noise. And by the time clarity arrives, positioning has already shifted. The unresolved tension remains. Is this institutional alignment foresight, or is it crowding? Is gold's strength a durable regime change, or a transitional phase? Is silver's leverage a gift or a trap? These questions don't require immediate answers. They require awareness. Because awareness doesn't eliminate risk. It changes how risk is experienced. And how risk is experienced often determines whether people stay positioned long enough to find out if they were right. Every market cycle eventually reaches a stage where narratives stop carrying the weight and mechanics take over. That's where this one sits now. Not at a moment of collapse, not at a moment of euphoria, but at a point where confidence is quietly relocating. And when confidence moves, it rarely asks for permission. For decades, confidence lived in yield. Bonds paid something. Cash felt productive. Equities rewarded patience as long as central banks remained credible. Investors learned a simple framework. Risk assets went up when policy was supportive, and down when policy tightened. That framework wasn't wrong. It just wasn't permanent. Inflation didn't break it overnight. It bent it slowly until the bend became visible. Once yield stopped compensating for erosion, cash stopped feeling neutral. Bonds stopped acting defensive. And investors were forced to confront an uncomfortable reality. Some assets were no longer protecting value. They were merely delaying the recognition of loss. That's where gold begins to matter in a way spreadsheets struggle to capture. Gold doesn't compete on productivity. It competes on honesty. It doesn't promise growth. It doesn't depend on policy discipline. It doesn't require confidence in future decisions. Holding gold is an acknowledgment that preservation sometimes matters more than optimization. Institutions don't adopt that mindset casually. When they do, it reflects internal recognition that traditional tools are constrained. Central banks reveal this recognition through behavior, not speeches. When reserve managers accumulate gold, they aren't expressing optimism. They're expressing caution. They're insulating balance sheets against scenarios where liquidity and credibility diverge. That doesn't imply collapse. It implies friction. Periods where policy choices involve trade-offs instead of solutions. Gold performs well in those environments because it isn't asked to solve anything. It's asked to remain. Silver remains the complication. It shares gold's monetary appeal, but it's tethered to growth in ways gold is not. Industrial demand introduces opportunity, but also vulnerability. Solar expansion, electrification, medical technology all support long-term consumption. But industrial demand doesn't respond smoothly to downturns. It contracts abruptly. That's why silver behaves less like a store of value and more like leverage on sentiment. This distinction becomes critical during stress. Gold tends to absorb uncertainty. Silver amplifies it. When growth expectations weaken, silver often sells off even as gold stabilizes. When confidence returns, silver often outruns gold. Investors who misunderstand this sequence often mistime their exposure, interpreting volatility as failure rather than function. Liquidity hierarchy adds another layer most people overlook. In moments of stress, markets don't sell assets equally. They sell what can be sold. Highly liquid instruments absorb pressure first. Futures markets move immediately. Tokenized assets trade instantly. Physical metal moves last. That sequencing explains why paper prices can fall sharply even as physical premiums remain firm. This disconnect unsettles investors who expect efficiency. They assume demand should immediately translate into price. But markets aren't just expressions of demand. They're expressions of leverage, access, and forced behavior. Margin calls don't care about conviction. They care about collateral. When leverage unwinds, prices move regardless of fundamentals. Tokenized gold accelerates this dynamic. It increases velocity. Velocity increases responsiveness. Responsiveness increases volatility. That doesn't invalidate the long-term case for gold. It changes the experience of holding it. Investors exposed through highly liquid vehicles feel every move more acutely, and acute experiences often trigger emotional decisions. Physical gold introduces friction. It's slower, less convenient, harder to trade impulsively. That friction is often framed as a disadvantage. In reality, it can be stabilizing. Assets that cannot be sold instantly are less likely to be abandoned during short-term stress. The structure of ownership shapes behavior more than most investors realize. Policy remains the largest unresolved variable. Leadership changes at central banks matter not because of what will happen, but because of what might. Markets price optionality aggressively. If policy tightens to defend credibility, gold may stall. If policy loosens to protect growth, gold may accelerate. The asymmetry favors patience, but patience carries emotional cost. Dollar dynamics complicate the picture further. A strong dollar pressures gold in non-dollar terms. A weaker dollar inflates nominal prices. But reserve diversification doesn't require a currency collapse. It requires marginal shifts. Even small reallocations, when scaled globally, create significant flows. Gold doesn't need consensus. It needs persistence. This leads to a more useful way of thinking about precious metals. Not as trades, but as expressions of uncertainty. Gold and silver don't reward optimism. They reward misalignment between expectations and reality. When markets overestimate control, metals tend to benefit. When markets underestimate resilience, metals tend to suffer. Neither condition lasts forever. Time horizon becomes decisive. Short horizons magnify noise. Long horizons dilute it. Institutions operate on horizons measured in cycles, not quarters. That doesn't make them infallible. It makes them survivable. Individual investors who align with that survivability experience fewer forced decisions even when prices move violently. The temptation now is to anchor on targets. 6,000, 6,300, 5,000. Targets feel grounding. They provide psychological closure, but markets rarely respect round numbers the way humans do. Targets aren't destinations. They're reference points. Focusing on them can obscure what actually matters, conditions. What would need to change for gold not to reach those levels? Sustained positive real yields, restored confidence in fiscal discipline, predictable geopolitics, coherent long-term policy. None of these are impossible, but all require coordination across systems that currently appear fragmented. That fragmentation is the quiet assumption underlying institutional forecasts. Silver's invalidation conditions are different. A sharp industrial slowdown, technological substitution, supply expansion, any of these could cap performance regardless of monetary demand. That's why silver rewards awareness more than conviction. It demands attention to multiple inputs simultaneously. The unresolved tension remains. Gold has already demonstrated resilience through repeated all-time highs. It has absorbed shocks without breaking structure. Institutions have reinforced their stance rather than retreating. And yet consensus often precedes discomfort. Not reversal necessarily, but challenge. Phases where belief is tested, not disproven. Markets rarely offer clarity at decision points. They offer ambiguity. The ability to tolerate that ambiguity often determines outcomes more than asset selection itself. Gold and silver don't remove uncertainty. They reflect it. They force investors to confront what they actually fear losing. As this cycle evolves, surprises are more likely to emerge from policy responses than from price action, from how authorities react under pressure, not from pressure appearing, from confidence shifting subtly, not from panic erupting. Those shifts won't announce themselves. They'll appear in language changes, quiet reallocations, and small signals dismissed as noise. So the real question isn't whether gold reaches a specific number or whether silver outperforms. The question is whether the systems people trust today will inspire the same confidence when they're tested under conditions they were never designed to handle. And when that moment arrives, will the assets you rely on behave the way you expect them to, or reveal that your assumptions were built on comfort rather than reality?